Okay. Okay, everybody. Welcome to the late hour market talk. This is Jim, the option professor. Quick background on myself. I've been in the investment arena here for many decades, and I've conducted seminars throughout the country and even into Canada on the uses and risks of options. And I was trained at the Options Institute in Chicago on advanced training. So between doing it for all these decades and having some proper training, I'm fairly knowledgeable in the subject. So I'm going to be going over what I like to see. Now, you would imagine after decades of being in this thing with so many people coming and going, you might have heard many things about how to follow the markets. In fact, if you want to get something I get a kick out of, I get a good chuckle out of. If I go down here to the word study and I go hit technicals, add technical study, look at this stuff. Bollinger Bands, dashed lines, Keltner channel, Arun up and down, Chaikin. What's my point? My point is there's 9 million ways to look at the market. I'm going to spend my time right now telling you how I've come to the conclusion of the best way. Okay. When I'm looking at the markets, I obviously am very informed because I'm watching my Bloomberg and my CNBC and my fast money and slow money and the Kramer and all the information I could absorb and the Barron's Roundtable and, all of them, right? And so I like to take in all the information and then I like to put it into my litmus test. And if it passes my stink test here, I might have an interest. Many things you hear on all those channels, I have no interest in because once I put it into my stuff, it reeks of a bad idea. So what are the things that I like to focus on? Well, after I get all this information and get a vibe of what's going on in the world, right? Like in the last couple of months, you got the idea that, we're coming out of tech and we're going into the small caps because the small caps have a P ratio that is at the cheapest level versus the S&P 500 since 2000. And the last time that happened was when, what happened after that is 5 years of outperformance on the small caps. So that made the small cap switch once we broke above 203. Technically, I'll show you in a minute, a very easy call. So that's the kind of thing that I like. I like to hear stuff and get an idea what the vibe is. Then I like to see my information confirm it. Now, my information, what's that all about? Well, two things I like to know about is I'd like to know what the trend is. How does that sound like? Sound like a good idea? Yeah. And I'd like to know the momentum, right? And those are the two things that I really like to focus on because I think everything else many times can be what they call a bologna sandwich or a hype or something that's going to get you in a lot of trouble. But I don't know that following the trend or understanding what the momentum level is a thing that's going to cause a lot of problems, right? And so I like to stick with that kind of stuff. So basically, there are a lot of different moving averages out there. I have my own that I like that I think are fantastic, but another guy, well, he's using the 8-day. That guy's using the 6-day. Well, you're going to get a headache with all the different moving averages you can put in. So, find something that seems to work for you and stick with it. The other thing is obviously on the relative strength, which we use the RSI down there, right? So I'll get into all this stuff in a minute. But before I do that, I also want to talk about how I like to look at the total picture. What does that mean? I'd like to know where we are in the realm of history, meaning a 20-year situation, then a realm of a 5-year situation, then a realm of a 1-year situation, and then a realm of a 1-month situation. And then when I put all that together, I have a much better idea if I'm looking at something that I might want to pull the trigger on. Okay. All right. So we're going to start with the S&P here. And the first thing someone would say if he fell off a cliff or he fell from the Mars, he'd look at this chart and he'd go, what the heck happened after 09 and 010? Because, there's never been this kind of volatility. And look at the market going like that. Holy cow. How does it go up like that? And then pulls back, yeah, because of COVID and a correction after COVID, but right back up in the face, right? So what causes all this kind of stuff? Well, one thing that causes it is printing money. And of course, the Fed has a balance sheet. And the Fed balance sheet changed dramatically right after this great financial crisis, because you can see when this great financial crisis was happening, it was underneath all my moving averages, and the collapse of the world looked like it was on hand. And when that happens, they'll start printing, believe me. And they came up with QE. So how do you get from here and keep going and going and going? You keep doing quantitative easing, which means printing money. And then what you do is you drop the interest rates down to zero. So everybody can buy a house with a low payment. Everybody can buy anything with a low payment. Your credit cards are lower payment. And that means spending, which is 70% of the economy, is going to go through the roof. And it has gone through the roof. Now, this is COVID. But do you see why I use my moving averages? First of all, the purple and the gold line are what they call the last stands. If you get under purple and gold, and look, when's the last time they did it? Oh, they did it during the crash of '08. And that's why they printed all that money. And that's why they went to zero interest. And that's why they went to QE, because it was a historic drop underneath an average that has not been ever penetrated. In fact, the gold hasn't been penetrated ever since. Whereas the purple has got a little close during COVID, but nowhere near since, because they've got the balance sheet up to 9 trillion at one point, and now they've got it down to a tidy 7 or 8 trillion, which is about 2 times what it was pre-COVID. So now you understand why we have all the wild gyrations in the asset prices, because money is all over the place, all over the place. Okay. But we have to wonder if it's going to last. Now, I use these averages to tell me about reversion to the mean. You see this? This is called overbought. And if you're buying up here, good luck to you. You won't find me next to you. But if you come down to the red line, that's a minor reversion. Green is an intermediate reversion, and blue is a full reversion. A excessive reversion is purple or gold. You got it now? Okay. So we are here, and the red line comes in at 48.23. You see it in the box there? So we're pretty far away from the red line here on a long-term basis, aren't we? And what do we know about reversion to the mean? Well, let me show you what we know about it. Gets away from the red line, comes back. Gets away from the red line, goes to blue. Gets away from the red line, goes back to the red line, goes over way, boom, back to blue. Gets way above the red line, boom, we get a crash all the way down to purple. That got your attention. Then we got way up here, got back to the red line, got back to green, got back to blue, got through blue, but don't forget, when the averages are still pointing up, the thing's going to go back up. How do you know? Because once it gets back above blue and back above red, then you know you're back on the bicycle, right? Okay, so that's why 4,200 was a key area. You see where, look at this, October 2023. Let me explain why old Jay Powell decided that day to start talking about how many cuts he had in store for interest rates. Do you know why he talked like that then? Because look at the graph here. You see, it's all those averages coming together. It's kind of like a big traffic jam, right? You know, you've all been in a traffic jam, four people coming into the thing at the same time, right? Or in a roundabout, you know. Well, it's not, you're not gonna stay in a traffic jam till the rest of your life. You're gonna move, right? And how are you gonna move? Somebody's gonna tell you, go this way, or you go that way. And that's exactly what happened here. Because if he doesn't talk now, if he doesn't come up with his little, we're gonna cut rates next year, it's possible we would break under here, under 4,000, and then 3,000 could come into play if things got nasty for whatever reason. But the carrot and the stick is not a cliche for no reason. The carrot basically was, we're going to cut rates next year for sure, right? I'm looking at, and he was talking about many cuts, right? Now we're almost at August and we got no cuts. But the point being is that got everybody into the markets, because obviously if you have no fear of higher interest rates, that's a pretty good relief. And lower interest rates means valuations can be easier to have. And lower interest rates means people could probably spend more money. All good stuff, right? And who's going to sell that? Then you throw in this AI thing where the whole world is going to change to AI, just like they did with electric cars, right? And everyone's going to use this AI, and you're not going to have any employees, and the companies are going to make all this money because everyone's going to get fired. You know, that kind of story. Well, that gets things going. And then, of course, you get companies investing in it, You saw the kind of revenue NVIDIA had at places like Google and Microsoft and et cetera. So they put in well, they got a ton of bucks because they're monopolies, right? I mean, who's going to get Facebook out of business? Who's going to get Microsoft out of business? Who's going to get Amazon out of business? Who's going to get Google out of business? I'll tell you, I'll help you the answer. Nobody. So obviously, those guys have a lot of extra money. It's called free cash flow. And they're throwing it at this AI thing. And they're throwing it in a company that obviously is making chips. Anybody know about companies that make chips who've been around a long time? It's kind of like anything else. They're very hot when the chips are needed, and there's not many of them. And then they get very cold when either chips change, more people come in to make the chips and cut their margins, or things change. You understand? That's what happens. Okay. So again, right now, every Tom, Dick, and Harry is bullish because look at that. Who wouldn't be? But I'm saying keep an eye on it, right? It's extended. It has potential to pull back to 4,800. What would that do to your stocks? Probably not help them. When could that commence? Well, let's see what these earnings look like at the end of the month with the big guys. Is Google making any money on AI? Do they still have a lot of cash coming in? Is Apple really going to hit numbers? Is Microsoft going to hit numbers? Are people pretty fully loaded on that cloud Azure? And let's just see what happens, because you know what, if these guys came in and said, you know what, that AI thing isn't panning out and we're not going to spend any more on it, and then all the tech sector went down, that's how you have a drop. That's how you have a drop. Okay, so we'll have to see, because right now there's no evidence of that, and I'll show you why. On the 5-year graph, well, here, let me show you one of the things. I watch the relative strength momentum. So here, you see this momentum up here is 75, 75, 75. What's the momentum up here? 69. 75 is higher than 69, which would be concerning that this has been done on lower relative strength than this. That's my opinion. Let's turn to the 5-year graph. Here you got your relative strength index at 73, 78. Up here, we are at 69, 77. Not too much of a divergence. Hey, the trend's still holding. Like I tell you, there's no evidence that it's going to roll over yet. That's why I'm not bearish. But I'll be bearish when it turns. I will have no trouble getting bearish, just like I wouldn't be having trouble bearish in 22. No problem getting bearish once that red line starts turning down. But not now, because the guys who've been bearish are now in the cemetery of financial ruin, because they fought the tape. They fought the law, and the law won, right? Okay, now let's talk about the 1 year. This is getting a little closer. You're underneath the red, which it hit today. You think it's a coincidence? 55.86 was the red line, and today's high was 55.85. What a coincidence. Now, if we get under the green, but they have to cross. You see, if you're going to get a substantial drop, they got to cross. So I'm a patient man, because this thing could be going as 5,900, and I'm not shorting it to find out that they're going to get me into something that's not going down. So breaking the blue would be nice if you're bearish at 54.80, and getting green, red under green, which means we got to be under 5,537, and we got to stay under there for a while to get the moving average to cross. So again, where is today? Today is the 23rd. And all this stuff is coming out in about 9 or 10 days. I would think in 9 or 10 days, if you don't go underneath the 50, where's the number here? The height of the day. If we don't go under 55.86 for the next 10 days, and we have constant closes underneath, and if we have any kind of constant closes underneath 55.37, then the stage may be getting set for the rollover. But not until. So has it been bullish? Yeah. Have I been bullish? You bet. Do I think it continues to go up? Why not? We don't have any turn yet. But we could have one. And when it does, you don't want to have a faraway look in your eye. On the 1 month basis, this is for shorter term traders, swing traders, weekly traders, that kind of thing. You use the monthly to get an idea. You've had some good time here, pretty much going up the whole time. Since when? 54.60. No reason to get out. Yeah, you got a reason to get out here. So you should pretty much be out between 56.20 and 56.40. You should still be out. Although I'd be careful with the blue line if it does get broken. So right now, again, the high of the day and that blue line pretty much in line, right? So that 55.85 that it hit today is an important number, 30 points higher than we are now. If you're negative on the market, boom, that would be your get out point. You want to be bullish on the market, me, I'd rather see it take out 55.85 and catch it on its way to 56.60 than find out I'm buying it here underneath this thing and find out what? It's going to start tanking. So that would be the way I would interpret something like that. Okay. So yeah, so there's your story on the S&P. And let me show you the QQQ. Here's your NASDAQ. Let's see what that story is. Always start with the long-term one because we want to know what the big picture is. Okay, this one doesn't, for some reason, I'm not getting the whole thing. I'm going to start with the 5-year, though. That gives you plenty of action. Yeah, you know what I mean? Last 5 years is when things gone nuts, right? So, let's just watch when things were going nuts. Now, you see my gold line down here during the 20s, again, during the 22. So, it starts banging against here. You take your shots. That's where you take your shots, not up here. You don't start buying it at 500. You take your shots, you add. Every time it pulls back, add. Come down here, you do a little adding. Add against blue. Boom, add against green or blue. But you don't buy on strength and then have the thing tank on you. Again, this RSI seems like it is a little exhausted. Here we go. What? We're in the 70 area, and up here we're at 70, 61. So, a little bit of exhaustion, but there's nothing pointing down. So don't be negative until it starts pointing down, or else you're going to lose your money. And then when you lose your money and it starts pointing down, you'll be disgusted and you won't even do the trade then. In other words, all these people that were shorting all the way up over here, I'm gonna hit this thing. This is overbought. Oh man, I'm gonna hit it again. I'm gonna hit it again. By the time they get up here, they were broke or depressed. So when they finally got the signal, they didn't do anything because they were already burnt out. So don't get burnt out here, because when it does roll over, and it always does, it'll be a nice ride. And if you haven't bought it all the way up, I mean, personally, I would say, I think you might have missed the boat, Joe. So I would say waiting for the rollover is the better play. Just my opinion. And like I say, if you have to trade every day, you might want to go see a doctor. But if you have to, then this isn't your game. All right. So anyway, let's look on the 1 year. 1 year, again, it's very similar to the S&P, right? Again, you're getting a little bit of a rollover. You got a gap there. So maybe they're going to pop it up there and fill the gap. If they don't, that's even more negative, right? So I would say right now, it's very important that the QQQ, if you want to be negative, it has to stay under the area of 490 and 486 and stay there for a while, maybe the next 10 days while it's waiting for this report. And this report is either going to be, I mean the earnings from the big guys. That's either going to bail you out, or it's going to confirm that this thing is going to roll over. And again, August and September are lousy months. And you know what? Hold your breath for a little while. You're going to be in August. So, I guess you're getting the idea that I think there's a wolf in the bushes and there's nobody prepared for it. And the answer to that would be yes. Because the giddiness and the happy days are here again is a very nice song. But if they play it long enough, it becomes an old song. And I don't know if it's an old song. We're going to know after earnings come out. So monitor it very closely. If you're bullish, you want it to stay above this blue line. So right now the blue line comes in around 479. You're right. Well, today in the aftermarket, it's underneath it. So again, it is starting to show some signs of crack on the 1 year. And the 1 month probably already told you to dump it. Yeah, told you to dump it at 498 here pretty much. Again, when you see action like this, but your averages are not pointing up, you try not to get sucked in on this. Try not to get sucked in on this. Not until the averages turn back up would the trends be back up. In my view, everything is my opinion, by the way. Everyone's got an opinion. This is my time to share mine. So there you go on the Qs, right? Again, they looks like they might be trying to roll over, but not enough evidence. It looks like the RSI went for 76 here, and then up here it's at 80, and then next door it's at 46. So obviously the RSI started losing some steam, and then it comes down, hits the blue line, comes back up. RSI only went back to 57, couldn't get through 60. If you can't get through 60, that means you're not going to go to the acceleration phase of 70 or 80, which means you might be looking at the top, right? Right. And that's what the top was right there. Down here, is there any divergence? Well, you got the lows here at 32 and you got the low here at 29. Not too much divergence. And the rally here, RSI comes up to around 50 and it's running right into the green line. So there's a reason why in the aftermarket here it might be backing off. And it's underneath the red line here in the aftermarket. You see 478 post-market, and that would be down here. Okay, king for a day. Who's king for a day? The small caps, that's who's king for a day. Okay, so this was a pretty easy one for me to call because it was pretty obvious. Now, again, this doesn't give me the good 20-year, but again, all the action's been happening in the last 5 years anyway. Okay. See, this move here, I always thought was a real scam because can you see all the averages were flattened out and flattened out? And it looked like everything was going to roll over, right? And then all of a sudden they bring it up to this brand new high. And anybody who is short, they all stopped out here. So I always wondered if anybody would look into who was selling up here to the people that were buying back their shorts, because those people might want to be, looked into because, they ran it up there and, it wasn't very long. And then boom, right back to where the trend was kind of telling you it was going to be. And then it was a tank job after that, even through the gold lines. So it's such an important sale. This action up here, I thought it was more than suspicious. I thought it reeked. It reeked. But anyway, so now you're down here and you're down here on this. And again, we get up above 180. So now you're back above gold. And now you're about the red turning up. So you want to start thinking about being bullish. But you don't want to get really bullish because you notice when you're under purple, the the bears are controlling it. When you're above purple, the bulls are controlling it, right? So the bulls needed to control it, which means we had to get above the area of 181. So once it got above 180, and let's call it 190. Let's call it about 190 right here, about 190. Yeah. Once it got there, you had to throw out your cap for the bears and you had to put on your bullish hat. Plus the blue line is just lovely, rising. And then it came down and got tested, but then it rose and rose. This is telling you you're in an uptrend, right? And then it all got together here again right at July 1st. And then people started publishing stuff like I mentioned. The S&P 600 small cap index, PE ratio, which means their valuation, versus the S&P 500 valuation is at the widest level since 2000. And the years after that occurred, the Russell had a fantastic time versus the S&P. It also was the top of the .com if you want to get nervous about that. So the point is that was interesting. But the most interesting thing is I could see it above the red line at 203. And then I went to the 1-year graph and I could see it getting above the red line at 203. So I don't need 19 reasons to get in. So this was the obvious area of a breakout. Now there's a gap here. I don't know if it's going to come down and get filled. It could, because if this little, shall we say, champagne party they're having with small caps ends, and when would it end? When the big caps earnings announce, and they say they're making tremendous amounts of money, and there's tons of money still going into AI, and their earnings not only beat, but they guide way, way higher. That would probably be the end of the drop in tech, and probably be the end of this. Because if things get hairy again, the 10-year note may go back up. I'll get to that in a second. So here you go. Good place to get in. Good ride. Came back close to the red line. If you wanted to take a shot at it, that's where you take your shot. Where's the red line? 214. Dropped to 215. That's a pretty tight stop. And then boom, back in the thing. So right now it looks very good. But again, it is really based on underweight and people coming in to a market that, there's no sellers. I mean, who's going to sell if you've been hanging on for all this long? Who's selling? Once it starts breaking out, you're going to sell? No. So there's probably a hard time coming up with a lot of sellers, and people made a decision, dump a little of your tech and go into the small caps, specifically for the reason I'm talking about, and also for the reason I'm going to show you right now. This is called the 10-year note. And I have been pretty good with this 10-year note because I have been a believer that the rates were going to be rising. And here's the story on the 10-year note going back 20 years. Okay. This was the bottom when the 10-year note yielded only 0.5%. Can you see 0.5%? And that's also about the time where negative yielding bonds were at about $17 trillion. Now, you guys who don't know what that means, I'll give you the cliff notes. You loan me money and I give your money back, but I give you back less than you gave me. And that could be for 5 years. Now, that's a pretty bad deal, isn't it? No interest, and you don't even get your principal back. And does that sound weird? Well, weird doesn't last. So the rate started to rise and rise and rise. And of course, they printed money, $9 trillion on the balance sheet. So there goes the rates. And of course, the inflation went nuts. We went to 9% inflation. So there goes the rates. Now, this is the trend of the interest rising. Wouldn't you say the interest rates are still in a rising mode? To me, they look like they are. But this 4% number, green, very important. So that's why I tell people, if it gets under 4%, my tune may very well change. And particularly if they can get these lines to cross. Because you know what? If they don't get the lines to cross like this, then the trend in interest rates is still up. So even if they break this stuff for like a little bit, maybe they ran it down to 350. Okay. But if these things never cross, that means the move down on this interest is going to be temporary in my view, and it's going to go right back up again. Not unlike what? They never got all these lines to go up, did they? Right? They never got the blue line to really point up. So every time interest rates looked like they were going up, they failed and went back down. Interest rates look like they're going up. No, they came back down because the lines are all pointing down. I didn't get fooled with this. I'm not going to get fooled with this. Right now, interest rates are still in an upward trajectory. Why wouldn't they be? Everybody's got a job. Everybody's wage has gone up. Everybody's charging a lot of money to eat, to go out and buy a car, to go buy your house. There's I hear this stuff about, America's in a bad shape. What bad shape? Go look at the price of your house. Very high. Go look at your stock accounts. They should be very high. Go look at your employment situation. You should be employed. I've been around the block. You know what bad times are? When it's a line around the block to get a gallon of gas. When people are getting laid off, where your house just dropped 25% in value. When your stock market has big crashes. That's bad times. I don't know where this we're having bad times comes from. I think it's a mantra people come up with, and I think it's very silly and dangerous because that's not what's going on as far as I can see. So, what's the story with small caps? They have been benefiting because 5% has gone back down towards 4%. And people are betting it's going back down towards 3.5% or something like that. Relative strength is still above 50. So there's no evidence that that trend is totally broken. It looks like it's just having a pullback still. Look at the 5-year graph. Again, it does look like it's rolling over, but they still haven't crossed all the way. But yes, it could easily drop down to the purple line, which is 383. But that doesn't mean the long-term picture will have changed. And that's what you got to be careful of. Because if you think interest rates are really dropping, and then the trends never change, like this blue line doesn't point down. You see, when the blue line points down, that's when rates are dropping. When the blue line's pointing down, I don't see that. I see an overbought reversion to the mean. That's what I'm seeing. Overbought reversion to the mean. So you could get lucky and get a nice pullback in interest rates, probably followed by what? Some inflation jumping up again, some other activity that our commodity prices start taking off, and then they got to go back up with the rates. So I wouldn't get too comfortable with the idea. And again, it's almost 100% of people say we're going to get a cut in September. Does that sound like a high consensus to you? So let's take a look at the shorter term, the 1 year. And you can see here that the RSI is 42.36. And over here, the RSI is at 42 near the low. And now it's at 47. So it's indicating that maybe the selling dried up. But again, the RSI is right there. It could go either way. But I wouldn't say it's 100% we're going to get lower interest rates unless the other inflation gauges really start giving it up or the job market gives it up. But there's no evidence of that now. And Powell's the same guy who said what? Inflation was going to be transitory, right? Wasn't transitory. And then he also said he's going to hike interest rates, right? So he hikes interest rates all the way to 5% here. What came down? What happened? What actually did that do? The price of housing come down with all this tightness? No. Did the price of vehicles come down? No. Price of going out to eat come down? No. So, I don't know. I don't know what effectiveness that Fed has had, because when they had interest rates, low, inflation went to 9%. When they have interest rates high, inflation is still going at 3% or better. That's on top of the 9%. You understand? You would think something that jumped up like your house 40% would then come down a bit, but they're not coming down. Not yet. So that gives you a little bit of an idea of some of the stuff going on right now. One other thing that might be interesting to you is the US dollar. This thing's, it's very close right now to being a very important spot. Let me show you. This is a 20-year graph, right? Okay, right now the high point has been 106, 107. And right now that is the high. But these haven't crossed yet, although they have crossed a little bit, but not like you have to see it to get a big drop. So we need to see, if you want to be negative on the dollar, you want to see it definitely keeping under 105, 104, and it's not really doing that right now. And you'd love to see it get back under 102 and get these averages pointing down. And then we could see if 97 is going to save us, or if it's going to be a full Monty down to 90. And it could go either way, because it's going to be exciting. And we've got what? We got Trump and Harris and, a lot of stuff hitting the fan. So that US dollar is going to be very key. If the US dollar is going to go down, which a lot of people think, because obviously they're not going to do anything about the deficits, it doesn't look like. And, they're printing money. And so basically, if that US dollar was to break and go down to purple, 97, or down to gold, then this thing here might give you a couple of things that might really take off, and putting a little bit in your portfolio might not kill you. This is Bitcoin. And here's where I thought it might have ended. You see the blue line? That's where I was telling people, you want to buy it? There you go. 48 all day long. When? July 8th. Or the day before when it got close to it. 49, 48 bucks. There you go. Gets underneath here. You could dump if you want. But more than likely, you're going to get a bounce. And did you get a bounce? You went to 60. How about $12 in 2 days? That's not bad, or a week. Right? So right now, again, if by the end of the year, like some people like Tom Lee think that this Bitcoin is going to go nuts by the end of the year, he's probably thinking the dollar will drop. And if in fact that happens, people will come out of, and the interest rates drop, people will come out of money market and want to do something with their money. Well, if they see their currency tanking and they see interest at the bank going out the window, they could jump into this thing. And if they do, and it blows out 65, then you're into what they call new high territory. Another one that people like is iBit. In fact, they like it a lot from the standpoint of volume, 46 million shares. But again, this one's new. But it is a more pure bet on the Bitcoin in some respects, I guess. I don't know. Bottom line, though, is this thing is opened up at 22 when it came out new in January, went up to 42, come all the way back down to 31, come all the way back up to 41, now back down to 31, now up to 39, now we're here. So the bottom line is it's new and it's moving around. But something like this, If you doing a long-term hold on it, maybe you'd start staging into it month by month and see if it holds its water. And then, of course, if it can show you additional movement on the upside, you maybe be better to add on a winning position than to uh, scale in, because you don't know, is the low down here or lower or whatever. But at least if if you're getting in at 41 and 42, then all these averages would be pointing up. And obviously there'd be something in the news telling you that people are putting their money in here, and then you'd have what they call momentum. Again, when that RSI gets above 60, you are in a position where we could accelerate to the upside, because just like your car, if you're going 60 miles an hour, that means you're going a heck of a lot more than when you started at 0, right? So you've already got momentum when you're going 60 miles an hour. How hard is it to punch it to go to 70 or 80? Not that hard. So that's why when these, like right now, the RSI is at 54 and this RSI was 61. Do you notice it petered out at 61? So if it can get through 39 and the RSI can get through to 60s and start pointing into the 70s or 80s, that'll be the time it'll probably blow out the 41. And that'll be the time you want to ride the horse. So I thought that was interesting because, I find that somewhat interesting. Now I'm going to go around the horn a little bit, and then I'm going to get into some ideas that I have that I'd like you to subscribe to and keep abreast of. So let's show you a little bit more about around the world. We just went over most of the stocks, interest rates, US dollar. Let's talk about some stuff like crude oil. Well, I'm going to start out with something else first. Let me start with something else. This is called the Goldman Sachs Commodity Index. Anybody heard of Goldman Sachs? Okay. So Goldman Sachs Commodity Index is something I watch. And I watch it all the time. So you can see here that it tried to get through the green line here in 2023, right? And then it tried to get through the green line here in 2024. And both times it failed. And so basically it's down here now. And half of this thing is oil, and the other half is pretty much grains and gold, which would mean if this thing is going to go down, those three items will possibly be in trouble. So if you look at the 5-year graph, there's a gap. You see the gap right here? And that gap is from 2022, and it's between about what's the low there? The high of that day is 702. And what's the low that day? 710. So between about 700, 710, there's a gap. If this thing was ever going to fill that gap, it would be very bullish for gold, very bullish for grain, and very bullish for oil, particularly oil, but also gold and grain to a degree. But you can see the purple line is controlling the stand, right? And you can't get above that 600 until you can. It ain't going up there. And now, right now, it is at a risk of going down and hitting gold again. And if it got under gold, this is called the abyss. So I think the commodity sector is either A, giving us a very good opportunity, or B, it's about ready to collapse. Because you see this thing is at 40 on RSI. And if RSI gets under 40, then it has a possibility of accelerating to the downside. Would you like some evidence of that? Let's show you some evidence. What's the RSI here? 47. And then it's 47. And then over here, it's 43. And then over here, it's 45. And so on the way down, it has not had any true accelerations to the downside. It's been able to hold 35 to 40. Even here, look at the low, 40, 41. So again, that tells me even more. If this thing breaks under 40, that would be lower than that. That would be lower than over here, right? And with this much room, reversion to the mean room, it could be a significant drop. So I'm monitoring this closely. Right now it is definitely in negative territory, and that's why I'll show you. Let's show you the components. You think oil's been going up? Looking at that chart, absolutely not. Oh, that's August 25. There's still a little bit of a shortage in the futures because we have backwardation. That means the front month is trading higher than the back. I just showed you the 25 is going for 71. This is 77. So there's still a tightness. But, this thing is definitely having a hard time with 85. Like I've been telling people, if you get through 85, last time that's Goldman Sachs thing was at 710. Oil was at 100, 110. I think that's where you're going if you can get above 85. I think the oil stocks will go through the roof at that point. But now there's a risk. The risk is going back down here to $70. And where's your RSI right now? It's at 45, so it's under 50. If it gets under 40, sayonara. So it's very key, very key. Looking at the 1-year graph, pretty much got the sell up there at 81. It's in a downtrend, trying to hold on to gold. So closes underneath the 77. Certainly wouldn't be good. RSI's at 40. What I tell you, you break under 40, you're going to be at risk for an acceleration to the downside. Would you get one? I'll tell you if you get one. If it starts breaking under 77 and the RSI starts breaking well under 40, this is where RSI goes down to 34. That's called an acceleration to the downside. Where was it up here? Before it broke, it was 42. You get the point? So very critical points down here for the oil. It's going to be pretty exciting here. It's either going to hold its water down here where it hit today, which is what? The low was 76.40 and and it closed above 76.91. So it closed above gold, but closes underneath 77 would be very tough. Now, like I say, you are also possible for a reversion to the upside. Remember, all these lines are not pointing down right now. So this could just be a reversion that stopped everybody out, and we're going to go right back up again. So like I say, this is a good time to focus on it and see if, in fact, it's going to hold. Because if it holds, everything on the oil sector is a bargain. If it doesn't hold, then everything is going to really accelerate to the downside. And from an election standpoint, people would like to hear that gas prices are down 20% or 20, 30 cents to a month before they vote, probably, if you're on that side of the fence. Okay, so there's your crude, and you can understand where the problem is. What's that done to XLE? XLE is pretty much Exxon and Chevron. Probably slipping a little bit. There you go. Okay, the 1 year is trying to hold on here for dear life. You see a big traffic jam. When I call traffic jam, that means it's probably going to make a big move. So bottom line is you've got a, what do you call it? You've got the moving averages coming in at 89. Oh, that's down there. Look at them all clustered. 91, 91, 90, 60, 90, 94. 91 is a key number. It's going to blow away from 99 one way or the other. This might be a time where you would price out a strangle if you thought it was going to make a big move one or the other. Let's take a look and see what they cost. A strangle means you're going to do a call and a put at the same time. You know why you're doing that? Because this thing could break either way. It could either be on support here and it's going to have a nice big move back up, or it could go into the soup and drop all the way down at least to gold. Let's see what the option prices look like. Say you go out till the middle of next month. What's a 1 month option cost here? Okay, you're at 91 is the key point. So you go a little bit out of the money on the call. So you go to 90, 92, put up $1.20. And then you go to a put underneath. And really, the put you'd want to have is really where the yellow line would break. So basically, if you went with a put, if you went with a put at 89, you're in there for about $2. Call $2, put $2, $1. So you got $2 on both. So let's go back to the chart. How do I go back to the chart? Thank you. There it is. Okay, So we were talking about like a 92 or 93 on the call and about an 89 on the put. So you'd need to think to have, you got $2 involved. So you got to have some volatility. But, if this thing went up and, you know, took out the high in the next month, boom, you get some action on that. And then, of course, if it goes way down, you get some action on that. Those premiums are a little bit on the high side for my taking. I'll show you things that I find a little bit more attractive in a minute. Anyway, that's your story on energy, and that's the story here. Now you got gold. That's another part of that Goldman Sachs index. And let me show you what gold looks like because everyone loves gold. But gold's had its troubles recently at 24.75. Let's see if that means anything. Okay, 20-year graph on the gold, and you can see here that again came down to the purple line, and then it's been traveling, and then boom, they start printing the money. Boom, it goes. Then of course we had a big drop in the stock market, but then right around here, that's when Powell says, "I'm going to cut those rates and give you some easy money," and that's when the gold takes off again. So down here, again, didn't really give you much of a downtrend, but once it got back above here, that's green light at 1800. That's green light because it broke above it, tested it. And after it tested it and got back above 1900 there, you really had a green light. Now up here, you're playing in the ozone and God bless you. It's either going to accelerate to the upside and go to 2700. But to start a position up here, that would be a little rough. Why? Because it could pull back to 2100, which is where the red line is. And if it does that, you're going to lose a lot of money by buying at 2500. And you have opportunities to buy on dips. You just got to take them. Had an opportunity right here at 2000. Even on the shorter term graph, you've had opportunities. This thing broke up, right? But, came down and hit purple here, right around 1800. Another reason to get in there then. And then boom, boom. And then it had a pull back to 2300. If you wanted to take a shot, I guess you could have done it somewhere down there. And the red line's still pointing up. So, you can't be negative. But that RSI is, a little lagging. RSI up here is at 80. On this high, it's at 62. And over here, it's at 65. Right now, it's trading at 65. So it could accelerate and go into the 70s and 80s. And then you're going to blow out 2500. But it's in the 60s. And so if it were to take out this red line, which comes in at 2360, I think then you could make a case that that's the high point for now. So be on top of it. Pretty exciting time. It's got a setup where it could either blow out the high and get going nutty, or it could have sucked everybody in on a weaker market and then come down and do a full reversion to 2200 or 22 something, right? So it could be a very exciting time for the gold, up or down. But like I say, if you're just starting to buy up here, that's a rough racket. Okay, and then just silver. A lot of people are into the silver nowadays. So let's look at silver. Again, 20-year graph on silver. Again, once it got above 25, 26, I told people now it's going to go. And that's what it did. And it still looks good, except that it's overbought and it could pull back. Again, it got under the red, but red's not pointing down. So I wouldn't trust that as a sell. It could come right down and start doing the full reversion. But if these lines still look like this and it goes down to green or blue, I would be looking to buy, especially against blue, because look, that comes in right at the former highs, which are now support. So I'd really be looking to buy at 26 if it gave it to me. Gets back above the red line, which is at 29.83, then you're a little bit back in business, and the RSI is at 56. So if you can get through the 60s, that's how you get to the 70s and 80s on RSI, and that's when you get really big moves. Really big moves. Let me give you an idea what a really big move is. You see right here, RSI is at 54. Then it goes to 58. Then it goes to 64. The next day it's at 74 because it's screaming. And after 74, it goes up to 82. And then it ends up way up here at 82. So that's what acceleration to the upside looks like. That's what I was talking about. And that's what you got to keep your periscope open for, Okay, we got 10 minutes left, so let me give you a little spiel here. I'm Jim, the option professor, and I have got uh, alert service called the Options Alert Service, and it comes out every week. And we go over a bunch of different ideas. Now, obviously, we don't give advice out to people. These are ideas that we think are favorable, and then they come to you, and then obviously you can look at them and figure out if you think they're favorable. But we've been doing this with strangle positions. So let me show you some of the ones we've done. They all don't work. Okay, they're not all going to work. But when you lose what? Just the premium. And when you win, you could win significantly if there's significant what? Volatility. Okay, so let me show you exactly what I'm talking about. Last month we did something with Apple. I did something with Apple. Okay, why did I do it? Okay, let's show you. Last month, Apple was trading between 195, 190. Remember this right in the beginning of June? And they were having the Worldwide Developers Conference. And I said to myself, you know what? They're talking about AI in there. And when they come out of that meeting, something's going to happen. Either they're going to come out with a lousy idea and it's not going to help the stock, or Apple's going to start talking about how they're going to add AI to the phone and get a reload cycle out of all these people. Either way, I don't think the stock's going to stay the same. So I went out 2 weeks after the 2 weeks and a 2 week option, and I bought a 200 call and a 190 put. 200 call was about $1.86, and the put was about $1.50, putting in about $300, $330 total price, which means all I could have lost in the entire world is $336, something like that. And Apple would have had to stay between the window for the next 2 weeks that I bought, right? Well, after they come out of the conference, obviously the news was very good, and it spikes up to 220, and the calls at 200 are 20 points in the money, which means they're worth $2,000, and they went from $1.86 to $2,000, $186 to $2,000. Okay. Then when it's up here, what you can do is you can take that put that's zero, take some money off the table up here, and maybe put a put on up here because you think it might revert back to the mean. And the puts don't cost too much because the market's way up here. And so if you do get a nice pullback quickly, those puts could go up. And then if you want to keep playing the game while it's down here, you could maybe look at the 220 or 225 calls. And then if it goes on another run, which it did, you can make a little money on that. So that's in a way you start out with a strangle and then you kind of trade out of it. Okay, we've had earnings coming out lately. I'd like to show you a couple of those. I thought JBH Hunt was going to do something because they had earnings coming up, and I liked the way the stock looked at the time. And this is one that could work on both sides. So could you see the market was right here? And if you go back to a long-term graph, it looked to me like it's down here at the 150, 160 level, and there's nothing until 130. So I thought it could drop down there or rebound back up. On the 5-year graph, again, it was underneath the gold, which told me that there's an abyss underneath if it fails. So I thought a 150 put and a 200 and a 170 call, 150 put, 170 call for about $2.60, $260 would be a good idea before earnings. And this thing jumped all the way up. You could see after earnings, it ran all the way up to 175. The calls went up to like about $8. And obviously that was a good strangle. And then if you wanted to, you take your money, and if you think it could pull back, you could buy a put up here cheap. And then when it pulls back, those puts could come alive as well. And then once it hits the green line, if you want to get it back into the calls, you could play that too. So I thought that was a good one. This is another one that was pretty good. General Motors went with just a 1 week option on this because I thought it was going to make a move and I didn't want to go too far out in time. So right here, you see how it's all a traffic jam? I love traffic jams because I really believe traffic jams get resolved big time. So there was a window about a 1 week option, 47 call and 45 put for $1, $100. And it jumped up to 50. So the 47 calls went to at least $3 or more from 100. So that wasn't bad. And again, if you press the put up, now this tank job, you'd be making money on your put. So sometimes after you make a lot of money on the calls, you take your gain and maybe you look at putting something on the put side because you're a believer of reversion to the mean. And it's limited risk. So if I take, if I take 4 or 5 out and I only put in $1, I'm still net ahead. That's the way you like to do it. Okay, so that's General Motors. What else? Last week's big one. I'll tell you about last week's big one. Taiwan Semi. And there's a very famous option company who was selling a put spread, credit put spread into this earnings report. And obviously that was a nightmare. I didn't do that. What I did is I bought a strangle. Why did I do that? Because this thing is trading up at 190 and I can see the RSI is shrinking. You know what that means? It means it's out of steam. It means this thing's run out of gas. So I think it's going to go into the tank. But I buy a 215 call and I buy a 180 put as an idea. And it comes to about $5. They come out and they drop all the way down here to 160 something. And the put goes to like $17. And on the put side, I think the put was like $3. So $3 went to $17 in a day. So if you can get in front of some of these earnings reports on a limited risk basis, I think it's very interesting because your risk is limited and your return could be substantial if you get volatility. And we've got a lot of earnings in the next few weeks, and I'm trying to be on top of all of them. This week, again, you got the metals, Newmont Mining, Freeport-McMoRan. You're going to have Chipotle coming out. You're going to have Google coming out. You're going to have a lot of stuff hitting the fan here. And Texas Instruments is coming out. That's already done its thing a little bit because this was something last week I was telling people about. And, check this out. When it's up at 210, RSI's here, having a hard time there. You go to 70, RSI over here is at 60, totally running out of steam. And then, of course, if we can break under blue, I think you got a nice abyss coming. If you can't, then it might go the other way. But it's interesting. It's interesting. So anyway, here's what you do. I'm going to be sending, you can go to the website, optionprofessor.com, OPTION professor.com. Or you can send me an email at optionprofessor@gmail.com. And if you'd like, I can send you the link where you can sign up for this thing. Now, it's a month-to-month deal. You're not signing up for the Marines here. You sign up, and the first thing you do is you get a master class course, which is 3 sessions, 6 hours of great material to learn about options. You get to keep that. And then you get a 50% off rate on the monthly rate, and it brings it down. Actually, it's $100 off, and it brings it down to $97. So for $97, you get to sign up. You get the master class. You'll get 4 weeks of information coming your way. I haven't gone over all the stuff you get, but you get a lot more. And again, you can opt out, unsubscribe if it's not for you any month you want to do it. So it's a very clean deal. If you have any questions at all, optionprofessor@gmail.com. OPTION professor, PROFESSOR @gmail.com. You go, hey, I'm Jim. I was at the meeting. I have some questions on the options alert service, and I'm interested in it, but give me more details or whatever your story is. Or I have some stocks. I wanted you to take a look at it and give me your view on it, your opinion. What do you think? What is your stuff saying? If you need help on something, again, contact me, give me your contact information. I ring you up, we talk, and hopefully we can do some stuff together. But like I say, there's no cost or obligation. I think there's a lot of value coming your way. You're going to get a great educational class, and you're going to get information, I think, that has value, not only on strangles, but on put writing, on spreads, and then we give you a market commentary and update on all the different markets that are out there. So I follow the stocks, I follow the bonds, I follow the gold and oil. So
hey, Jim, sorry, I got to cut you off.
Okay, sounds good. I'll welcome everybody, and hopefully we'll hear from you. Have a great day.
All right, great. Thanks, Jim. That was the Option Professor of optionprofessor.com.